Good morning. Today we are going to discuss investment decision. Investment decision, if I can talk it about briefly, is one of the key decisions in finance. The success of any business depends on how it has invested. If you select a bad investment, however good sources of finance you have, automatically the business will fail. So today's discussion, we are going to look at various issues that related to investment decision. So the main topics that we are going to discuss, uh, we shall look at time value of money, we shall look at investment appraisal techniques, we shall look at how to incorporate inflation and tax in investment appraisal, we shall look at how to incorporate risks in investment appraisal, we shall look at lease and buy in investment still appraisal. Then we shall look at issues related to capital rationing, and our last part of the discussion, we shall look at replacement decisions. So let's begin our discussion by looking at time value of money. So I can say that time value of money is one of the important tools in investment. So it is a principal tool that we use in evaluation of investment. Why is it important? Why is the time value of money important in investment? The main issue is that there is always a difference between the period of investment and the period you expect the return on investment. So because of this difference in period, it becomes very complicated to compare cash flows of different years. So to be able to compare cash flows of different years, then you need the tool of time value of money. So cash flows of different years that you expect to get or you expect to invest can only be put under the same time base if you use a principle of time value of money. These are the common features of time value of money. As I've said, time difference between sowing and reaping. That is, there is a time difference between when you invest and when you expect the return on your investment. So if you invest maybe today in a government bond, you expect maybe to be receiving a certain amount from that bond in future. Or if you deposit money into a fixed deposit account, you expect to get your return maybe in a given period of time. So there is a difference between when you invest and when you expect the return on your investment. And another principal feature is that both seeds and leaves can be at specified time or a series equal or unequal. So when you make an investment, there are some investment where you can be able to get your seeds and the principal amount you invested and the return on your investment. But in some investment, when you invest, you may only be getting your return on investment. For example, if you invest in, for example, in preference shares, you can only be getting a return on investment from your preference shares. But if you invest in a bond, you can be getting a return on investment, which is going to be your RIPS. But at maturity of that bond, then you are going to get your principal amount, which is going to be your seed. So different investments have got different way or different series of seeds and reps. And then another principle is cash flows are compared only at time basis. That's what we have talked out in my introduction when I was introducing the principle of time value of money. You cannot compare cash flows of year 1 with cash flow of year 2. You can only use a comparison if you apply a time base. And to be able to compare those cash flows, then you need this principle of time value of money. So let's look at future value. How do you compute the future value? So to compute the future value, we get our future value will be equal to the present value into 1 plus r power n, where n is the period, fv is the future value, pv is the initial principal, or what we call the present value, and our r is the interest rate. You can as well use financial tables to compute your future value. So if you use financial tables to compute the future value, your future value will be equal to the present value or the principal amount you have invested times the future value interest factor, meaning that you are reading this figure in a future value interest factor table of interest R and period N. So you can read this in your future value interest factor table, then multiply by your principal amount, or what we call the present value, and then you can be able to get your future value. So we can look at this example that you invested 1 million, meaning this is your principal amount, or what we call the present value, and the interest rate is 10% and the period is 5. Please, questions of managerial finance or questions of financial management, those who do SCA, you need to know how to get information from the question. So this is your principal, which is your present value, this is your interest, and this is your period. So you can substitute in our formula here. So meaning our future value will be 1 million into 1 plus 0.1 power 5, and you get this. If you use financial tables, so as I said, you are going to read this figure in your financial table, and then you determine your present value. So let's look at the present value. When it comes to the present value, as we said, you expect to pay a certain amount in the future, or you expect to receive a certain amount in the future, and you want to know the present worth of that amount that you expect. So when we are computing this, so we are going to get our present value will be the future value, that's the amount you expect to pay or the amount you expect to receive, divided by 1 plus r power n. Then you get your future value, present value. So where these figures we have already, this is the future value, this is our discount rate, and this is the period n. So you can as well use financial tables. You can use financial tables to determine your present value. So if you use a financial table, the present value will be equal to the future value times a present value interest factor of interest R in period n. So you are reading this figure in present value interest factor table. So that is how you can do it. So we can look at this simple example that you are to receive this amount. So this meaning you are going to receive, this is your future value, 5 years. So that is our n is 5, and you wish to find its present worth today. So what is the present value of this figure that you expect to receive in 5 years today? So your R is 10%. So you can substitute in this formula that we have already talked about, and then you have your present value equal to the future value, which is this, over 1 plus 0.1 power 5, and you get 1 million. You can as well use your financial table. If you use your financial table, you can just put your present value, which is this, then you read this figure from your financial tables. In our previous example, we were looking at a lump sum amount. You expect to invest a lump sum amount, or you are expecting to receive a lump sum amount or to pay a lump sum amount. But in some cases, someone may be, or an investor may be investing, or you can invest different amount in different years. So if you are investing different amount in different years, or you are expecting to receive different amounts in different years, then you have what we call multiple cash flows. So if you look at the future value of multiple cash flows, meaning you are investing different amounts in different years. So the future value of multiple cash flows will be the summation of the future value in different years. So you are going to get the future value of year 1 plus the future value that you invested in year 2 plus the future value of the amount you invested in year 3 and so on. Then you add them together and then you get the total amount. So dear members, what you need to be very careful in this is that one of the assumptions that we use in investment is that we assume cash flows occur at the end. So if you are to invest in year 1, we assume that you are going to invest at the end of year 1. So if you are investing at the end of year 1, it means this cash flow will get interest or will earn an interest for a period of 4 years. You cannot count the first period. So when we are calculating the future value, unless the question has told you the total amount of period, but if you are investing in these different cash flows, so we are expecting you are investing at the end of year 1, so it's going to be n minus 1. That's why here we have power 4. It is n minus 1. Here it is power 3 because it will be n minus 2. Here it will be n power 2 because it is n minus 3. So you add this total and then you get your total future value of multiple cash flows. So let's look at multiple cash flows, present value of multiple cash flows. Still in the present value of multiple cash flows, you are expecting to receive different cash flows from different years, or you are expecting to pay different cash flows from different years. So in this case, maybe in year 1 you can be expect to receive 100, year 2 you expect to receive 300 and so on, but you are expecting different cash flows from different years. So when we are talking about present value, we always begin with period 0, unlike in future value. But when it comes to present value, we count from period 0. Where you are standing now, we calculate it as a full period. So when we are counting periods, even period 0 is considered in present value, because we consider it as a full period in our calculation. So when we are discounting, for example, if you look at this example, these are different cash flows that you expect to get in different years. Year 1, year 2, year 3, year 4. So this cash flow will be brought back here for one period. So that is going to be 200 over 1 plus our discount rate is 12%, 1.02 power 1. This one will be brought back here to period 0 for period of 2 for 2 period. This 500 will be brought to period 0 for 3 periods, and this one will be brought back here for 4 periods. So you discount these cash flows using our formula that we looked at in the previous slides, then you sum to get your total present value of multiple cash flows. So let's look at level cash flows. We have looked at when we are investing a lump sum amount. We have looked at when we are investing different cash flows. But there's when you can be having level cash flows. When we say level cash flows, or what sometimes we call them constant cash flows, or sometimes we call them annuities. As long as you have constant cash flows, then those cash flows we call them annuities. Now, the annuities can be classified into two. We have what we call an ordinary annuity and what we call annuity due. So if you are looking at an ordinary annuity, it means your cash flows occur at the end of the period. if it is an ordinary annuity, the cash flows occur at the end of the period. If it is annuity due, then your cash flows occur at the beginning of the period. Please separate these two. As long as the question is the cash flows occur at the end, then that one is an ordinary annuity. But if the cash flows occur at the beginning of the period, then that one is an annuity due. So when we are computing, we need to know the difference between an ordinary annuity and an annuity due. So still you can have a future value annuity, or you can have a present value annuity. So you can have future value annuity due, future value ordinary annuity, or present value ordinary annuity, or present value of annuity due. So you just need to know when does the cash flow occur. So let's look at the future value of ordinary annuity. So if you're looking at the future value of an ordinary annuity, we are saying you are investing a constant amount, but at the end of a given period. So if we use financial tables, to calculate a future value of ordinary annuity, we are going to get our constant. This PMT is a constant. We are going to get the constant times the future value interest factor, which is in interest R period N. Meaning in this case, you are using annuity table, a future value annuity table, and read interest R percent in period N, and then determine your future value interest factor. The future value interest factor that you are going to get here is multiplied by your constant amount you are investing to get the future value of an annuity. If you don't use that, if you are not using the table, then if you are using your calculator, it's going to be the constant that you are going to get, the constant what you are investing, into 1 plus R power N minus 1. Then the whole of this is divided by R. Then you can be able to get your future value of annuity. So you can apply this in your formula and then determine the future value annuity. So let's look at present value. We are looking at ordinary annuity. So in present value of an ordinary annuity, as we have said, you expect to pay, or you expect to receive a certain constant amount at the end of each period, because it is an ordinary. It is at the end of each period. So when we are computing the future value of an ordinary annuity, we get the constant. We are using financial table times the present value interest factor. You are reading in the present value annuity table, interest R period N. So if you don't use that, you can use your calculator. We are saying you can use this one. In this case, you are using your financial tables. If you don't use the financial tables, then you can use your calculator to calculate. And if you use your calculator, your present value of an annuity is going to be 1 minus into 1 plus R power minus N. Then the whole of this is divided by R. Or you can use 1 over R minus 1 over R, then into 1 plus R power N. So you get the same answer. Then you can be able to get your present value of ordinary annuity. You can look at this example. Find the present value of series of equal periodic payments in an ordinary annuity. So you see series of equal, then it means that is an annuity. But in this case, they have told us it's ordinary. If they had said at the end, then automatically that one is an ordinary annuity. So 1 million received at the end. So it is even mentioned here, received at the end of each of the 3 years. So that one automatically it is ordinary annuity. So in this case, we have used the financial table. You can cross-check your financial tables. You are reading interest rate 6%, and you are reading it in period 3. Please, you are opening annuity table, not present value table, but a present value annuity table. Open your present value annuity table, look in the interest rate 6% period 3. Then you are going to look at this factor. So once you get this factor, multiply by your constant amount, and then you get your present value of an annuity. So let's look at level cash flows, but in this case we are looking at annuity due. As I said earlier, that if it is annuity due, the cash flows occur at the beginning of the period. So because your cash flows occur at the beginning, there is always an extra period that you need to compound. So if you have, it means you will have an ordinary annuity, and this ordinary annuity is going to be compounded for one period, then to get a future value of annuity due. If it is a present value, the present value will be discounted for an additional period to get a present value of an annuity due. Already talked about that you have an ordinary annuity, and your ordinary annuity is discounted for one more period to get your present value of annuity due. Please watch the next video for the application of annuities in investment decision. Thank you.